Hello students, welcome to BBA 407 Strategic Management. I am your instructor Mine Doyran. Today I will talk about the importance of financial statement analysis for strategic management. I continue my lecture with the profitability ratios. In part 1 of my lecture we talked about risk ratios, and today we will be talking about profitability ratios. As you can see here in illustration 12.16, we summarize the 6 profitability ratios to examine, and then we will discuss the significance of each of them, and we will also discuss how to calculate them. These 6 ratios focus on profitability, the primary measure of company success. All profitability ratios measure the earnings or operating effectiveness of a company. Not only is profitability necessary to survive as a company, it is the primary indicator used by investors and creditors in making financial decisions. So investors and creditors, when they are making key decisions, they will always look at the profitability ratios of the companies. So starting with the gross profit ratio. This ratio indicates the portion of each dollar of sales above its cost of goods sold. So if you look at the formula of gross profit ratio, you see that we calculated by dividing net sales by gross profit. In other words, gross profit divided by net sales gives you the gross profit ratio. However, to be able to find this ratio, you have to find the gross profit first. How do we find the gross profit? Gross profit is net sales minus cost of goods sold. So we find the gross profit as net sales minus cost of goods sold. And then we divide this number by the net sales. In other words, to be able to find the gross profit ratio, I should also give you the indicators or the values on net sales as well as cost of goods sold. Gross profit ratio vary by industry. This illustration presents the calculation of the gross profit ratio for Under Armour, and it makes a comparison with Nike. As you can see, Under Armour's gross profit ratio is higher than Nike's gross profit ratio. Under Armour sells its merchandise for about twice what it costs to produce. In comparison, Nike has a gross profit ratio of 43.4%. Nike's gross profit is still quite high, but not as high as Under Armour's. Overall, higher the gross profit ratio, higher the profit or the overall operational effectiveness of the company. In other words, higher value is always better. Higher the better. Higher profitability means higher or greater operational effectiveness. The second ratio is the return on assets. It measures the income the company earns on each dollar invested in assets. We calculate it as net income divided by average, but not ending total assets. So we're always looking at the average total assets. Average total assets are calculated as beginning total assets plus ending total assets divided by 2. This illustration again provides the calculation of return on assets for Under Armour and a comparison to Nike. As you can see, Under Armour has a much greater, Nike has a higher or greater ratio on return on assets than Under Armour. Under Armour earned a return on assets of 12.4%, which is lower than Nike's return on assets of 14.6%. Then we can further separate return on assets into two ratios, one being the profit margin and the other one is the asset turnover. Profit margin measures the income earned on each dollar of sales. We calculate it by dividing net income by net sales. In other words, it is a ratio of net income to net sales. So again, this slide is comparing Under Armour to Nike. Under Armour has a profit margin of 7%, meaning that for every dollar of sales, 7 cents goes toward net income. Nike has a higher profit margin of 9.2%, which means that Nike's profit margin is greater than Under Armour's profit margin. Again, in this ratio, higher value is always better. Higher the profit margin, higher the operational efficiency and effectiveness of the company. Now let's look at the other indicator of profitability, the asset turnover. It measures sales volume in relation to the investment in assets. We calculate asset turnover as sales divided by average total assets. Don't forget, we're always using average total assets in this ratio. How do we calculate average total assets? Ending total assets plus beginning total assets divided by 2. Then we compare Under Armour's asset turnover to Nike's asset turnover. Under Armour generates 1.80 in sales for every dollar it invests in assets. Nike's asset turnover is just slightly lower at 1.6. The other most important indicator of profitability is the return on equity. It measures the income earned for each dollar in stockholders' equity. Return on equity relates net income to the investment made by owners of the business. The ratio is calculated by dividing net income by average stockholders' equity. Again, average stockholders' equity is calculated as beginning stockholders' equity plus ending stockholders' equity divided by 2. Again, this illustration compares the return on equity between two companies. Under Armour has a return on equity of 17.8%. So what this means is that its net income is 17.8 cents for every dollar invested in equity. Nike has even higher return on equity of 22%. It means that Nike is a more profitable company than Under Armour when you use the return on equity in measurement. The other indicator that we look at is the return on the market value of equity. To supplement the return on equity ratio, analysts often relate earnings to the market value of equity, which is calculated as the ending stock price times the number of shares outstanding. In other words, to be able to find this ratio, you need to calculate separately market value of equity. And market value of equity is calculated as the ending stock price times, meaning multiplied by, the number of shares outstanding. So in other words, if I give you a problem, I should definitely give you indicators. on the ending stock price and the number of shares outstanding. Otherwise, you will not be able to calculate this ratio. The return on the market value of equity is computed as the net income divided by the market value of equity. The other indicator we use is the earnings per share, EPS. EPS measures the net income earned per share of common stock. We calculate earnings per share as net income minus preferred stock dividends divided by the average shares outstanding during the period. The upper half of the fraction measures the income available to common stockholders. Then we subtract any dividends paid to preferred stockholders from net income to arrive at the income available to the true owners of the company, meaning the common stockholders. But don't forget, if a company does not issue preferred stock, the top half of the fraction is simply net income. So you simply divide net income by the average shares of common stock outstanding if the company does not issue preferred stock. We then divide income available to common stockholders by the average share outstanding during the period to calculate earnings per share. Earnings per share is useful in comparison or in comparing earnings performance for the same company over time. However, it's not useful for comparing earnings performance of one company with another because of wide differences in the number of shares outstanding among the companies. So which means is that we're only using this indicator to understand or to evaluate one company's performance over time. You do not use it for comparison purposes because companies have wide differences in the number of shares outstanding. The last indicator that we will be looking at is the price-earnings ratio. The price-earnings ratio compares a company's share price with its earnings per share. The PE ratio is an indication of investors' expectations of future earnings for the company. Again, this is a very important measurement or an indication of investors' expectations of future earnings for the company. This illustration presents the PE ratios for Under Armour and Nike. We find the PE ratio by dividing earnings per share by the stock price. At the end of 2012, Under Armour's closing stock price is $48.53, and the company reports earnings per share for 2012 of $1.23. This represents a PE ratio of 39.5%. The stock price is trading at 39 times earnings. In contrast, the PE ratio for Nike is 22.4%. Stocks commonly trade at a PE ratio somewhere between 15 and 20. So as you can see, both Nike and Under Armour is trading at a ratio higher than 15 and 20. So at 33.5, Under Armour has a very high PE ratio. 39.5 is way above the threshold of 20. It appears that at least at this point in time, investors are more optimistic about Under Armour's future earnings potential than Nike's, as shown by the price they're willing to pay for Under Armour stock. So this is all about investors' expectations about countries' future potential. But when investors make their investment decisions, they will not only look at price-earnings ratio or other indicators of profitability. They will also look at risk ratios, such as debt to equity ratio and the liquidity ratios. Thank you for listening to my lecture, and I will see you next week. Have a good day.